Please open your standard IFRS 10 at B24. Bear with me. I will have to read through the examples with you and then I'm going to explain them in terms of the principles, the theory. To be substantive, rights also need to be exercisable when decisions about the direction of the relevant activities need to be made. Usually, to be substantive, the rights need to be currently exercisable. Look at this, usually. However, sometimes rights can be substantive even though the rights are not currently exercisable. Okay, so when you look at the principles that we've just covered, remember we've indicated that substantive rights will be voting rights or potential voting rights. Now, with the potential voting rights, we've indicated currently exercisable. But if we look at a substantive right, a right can be substantive even if it's not currently exercisable. Okay, now if we look at this example, example 3, the investee has annual shareholder meetings at which decisions to direct the relevant activities are made. The next scheduled shareholders meeting is in 8 months. However, shareholders that individually or collectively hold at least 5% of the voting rights can call a special meeting to change the existing policies over the relevant activities. But a requirement to give notice to the other shareholders means that such a meeting cannot be held for at least 30 days. Therefore, if you look at the right side of your screen for me, please. They indicate to us that shareholders that individually or collectively, therefore on its own or together, owns 5%, can call a special meeting to change existing policies. But this special meeting cannot be held for at least 30 days because they need to give notice to the other shareholders of 30 days. Policies over the relevant activities can be changed only at a special or scheduled shareholders meeting. This includes the approval of material sales of assets as well as the making or disposing of significant investments. Now, the above fact pattern applies to example 3A to 3D. Right, now let's just make sure we understand this again. On the right side, shareholders on their own or together collectively that holds 5% can call for a special meeting where they can actually now change the policies of this entity. But this special meeting will only occur within 30 days because they need to give 30 days notice to the shareholders. Now, example 3A, an investor holds majority of the voting rights in the investee. Therefore, we have our shareholder, which owns the majority. The investor's voting rights will be substantive. Think about this, majority. Therefore, let's say 80% of the investee. Now, this shareholder on its own will have the right to call for a special meeting to be able to change policies of the relevant activities of this entity. Therefore, if you look at this, it is a right where the shareholder can exercise now. Even if they have to wait 30 days, this 30 days period is just to be able to give everybody notice that this meeting will happen. But at the date when they call for this meeting, this shareholder already has the right to affect the relevant activities. Therefore, this right will then be substantive. Okay, next. An investor is party to a forward contract to acquire majority of shares in the investee. The forward contract settlement date is in 25 days. the existing shareholders are unable to change the existing policies over the relevant activities because a special meeting cannot be held for at least 30 days, at which point the forward contract will have been settled. Okay, so if you look at this again on the right side, okay, so when we have an entity or combination, they may call for a special meeting where policies can be changed. Now, if they decide to call for this meeting on day 1, this meeting can only occur on day 30. And this investor has a forward contract which will be settled within 25 days. Now, if you look at this forward contract, the forward contract will give the investor the right to acquire majority of shares. Therefore, if we say, for example, again, 80%, this contract will give the right to the investor to obtain 80% of the shares. Therefore, if the investor has 80% of the shares, the right will be substantive. Now, if we look at the 25 days period, do you think this is a problem? No. Why not? Because on day 30, when they make this decision or when they are able to be at this meeting, have the special meeting, the investor will be able to make the decision and exercise that right. Therefore, the investor's forward contract is a substantive right. It has the potential to give the investor a right at the meeting. Then example 3C, the investor holds a substantive option to acquire the majority of shares in the investee that is exercisable in 25 days and is deeply in the money. Therefore, the same conclusion would be reached as per B. Example 3D, an investor is party to a forward contract to acquire the majority of shares in the investee with no other related rights over the investee. The forward contract's settlement date is in 6 months. Okay, again, if you look at our timeline, now this investor can only settle this forward exchange contract within 6 months. Therefore, on the date when they have this special meeting, do you think the investor will have a right? No, because this period is only in future, not current. It is in future, not current. Example 4. Right, now when you look at my right side, this example indicates to us that we have an investor that owns 48% and the remaining 52% is earned by other investors, of which none of them owns more than 1%. And it is important that there is no agreement between any or no arrangement between any shareholder. Therefore, when you look at this, the size of this investor, the 48%, and the fact that the other shareholders each only owns 1% or less. In terms of this scenario, none of them are able to combine their votes. This does not exist. Therefore, in terms of this example, we are able to conclude that this investor will have the power over the investee in terms of its relative size and the size of the other shareholding. Example 5. When you look at the right side, we have investor A, which holds 40% in the investee, and then there is 12 other investors which each owns 5% in the investee. But there is a shareholders agreement which provide investor A with a right to appoint and remove key management personnel. Therefore, due to the fact that the shareholders agreement provide investor A with the right to appoint key management personnel, and key management personnel will be able to make decisions in terms of our relevant activities. This will provide A with power over the investee. The fact that the investor might not have exercised this right, or the likelihood of the investor exercising the right, shall not be considered when assessing whether it has power. Therefore, even if A did not use this power or use this right to be able to select or remove key management personnel, it's irrelevant. A will still have power because there is this separate shareholders agreement, the de facto method. Remember, there's a separate shareholders agreement that will provide A with a right. Example 6, when you look at the right side, we have investor A, which owns 45% in the investee. Then there is 2 other investors, 26%, 26%, and then 3 separate investors, which 1% each. Therefore, if we look at the size, it's less than 50%. Therefore, in terms of the size, there is no majority vote. Is there a separate agreement? No. When you read the information, there is no agreement. Therefore, we are able to conclude that investor A does not have power over the investee. Right, in this example, our investor owns 45%, not 40%, guys. 45%, and we have 11 other investors, each owning 5%. Now, if we look at this, they indicate to us that there is no contractual arrangement to consult any of the others or make collective decisions. Therefore, none of these entities have an agreement. If we look at the scenario, in terms of the size, the voting rights is 45%, it's less than 50%. And there is no agreement between these entities who makes decisions or if they need to be together to make decisions and so forth. Therefore, if you look at this, there is no information to be able to conclude if there is power, and we will have to obtain additional facts and circumstances. We're not able to conclude. Example 8, the scenario indicates that the investor holds 35%, 3 other investors each holds 5, 5, 5. And then the remaining 50% is held by quite a few, numerous other shareholders. None of them owning more than 1%. Now, our first question, the size will not give the investor a right. The size is 35%. Is there a separate arrangement? None, which we are able to identify. Then they indicate to us decisions about the relevant activities of the investee require the approval of a majority of votes cast at relevant shareholders' meetings. 75% of the voting rights of the investee have been cast at recent relevant shareholders' meetings. Now, it indicates to us that 75% of voting rights have been cast at other meetings. Now, if I just take this one step back, and let's just use normal terms. The MOI of this company, Memorandum of Incorporation, indicates to us that of all of the shareholders present in a shareholders meeting, when decisions are made, 75% of all of these shareholders should vote. Now, in a scenario, you will have to read very carefully. They can indicate to you, based on history, our investor with 35%, if we are able to identify, let's say in year 1, year 2, year 3, in year 1 of all of the shareholders present. Now, if we say, for example, now just listen here. If we say, for example, only 50% of the shareholders were present for the past 3 years, but each year our shareholder with a 35% were present, and our shareholders with a 1% were present, therefore 15% individual shareholders, each owning 1% only. Okay, you with me? Therefore 50% of the total 100% has to be present, and of this 50%, 75% of every shareholder present should vote. And each year, 35% shareholder, which is one entity. Therefore, if we look at this, 35 over 50, 50 will represent 70%. You will have to read the scenario very carefully, because if you now look at this, it indicates to us in terms of our MOI, 75% will have to vote in terms of everyone present. Now, if only shareholder 35% vote, 70% will vote. Now, if they indicate to us that they have approved these votes, then we are able to conclude that there will be power. But if they indicate to us that these votes decisions were not approved, then there will not be power. You will have to read your scenario extremely careful. If we change the scenario a little bit, and let's say, for example, that our shareholder owned 40%, one shareholder owned 40%, and this will then be 10%, 40 out of 50 will then be 80%. Then it's easy. This will be, yes, there will be power. Because based on history, we were able to prove that this shareholder were able to make the decisions at the meetings. Example 9. Right, now you need to be awake with this one. I'm going to read through the scenario briefly, then I'm going to explain it. Investor A holds 70% of voting rights of an investee. Investor B has 30% of the voting rights of the investee, as well as an option to acquire half of Investor A's voting rights. Therefore, on the right side, we have Investor A that has 70% voting rights, and we have Investor B that owns 30% voting rights plus an option to acquire 35% voting rights of A. Now, they indicate to us the option is exercisable for the next 2 years at a fixed price that is deeply out of the money and is expected to remain so for that 2-year period. Now, if we look at this deeply out of the money, you need to look at this from the investor B's point of view. Therefore, remember, this is an option to purchase shares. This is not shares. Deeply out of the money means that the fixed price exceeds the market price. Therefore, if investor B purchased these shares, investor B will technically lose because investor B will have to pay more than market price. Therefore, investor B will be out of money. Let me repeat myself. Investor B may buy the shares at a fixed price, which exceeds market price. Therefore, for example, let's say investor B can purchase these shares for 100,000, but market price will be 70,000. Will it be a wise decision? No, because investor B can purchase these shares for 70,000 in the market. Why will investor B now want to pay 100,000? Therefore, investor B will be 30,000 out of money. Right. Therefore, if you look at this, the indicator as further, investor A has been, look at the sentence, investor A has been exercising its votes and is actively directing the relevant activities of the investee currently. Therefore, A has been exercising its votes and have been actively directing the activities. In such case, investor A is likely to meet the power criteria because it appears to have the current ability to direct the relevant activities. Although investor B has currently exercisable options to purchase. Guys, what is the possibility that investor B will exercise this option? Pretty low. I doubt. Because he doesn't want to be out of money. Therefore, in this scenario, it's most likely that A will be able to have power and the options in terms of B will not be considered to be substantive. Example 10, right. Example 10 indicates to us that investor A has 33% and there is 2 other investors each owning 33.5%. It indicates to us that the investee's business activity is closely related to investor A. Therefore, if you look at this, I've included pretty similar business activities. And that investor A has a debt instrument which can be converted into ordinary shares at any time for a fixed price that is out of money. But not, look at this, but not deeply out of money. If the debt were converted, investor A would hold 60% of the voting rights of the investee. Now, when we look at this, it is out of money, but not deeply out of money. Therefore, yes, maybe investor A will lose a little bit. Compare up to our previous example. Look at our previous example. They've indicated to us that it's deeply, a lot out of money. Now, but not deeply out of money. It's out of money, but not deeply out of money. Therefore, deeply out of money, they will lose a lot, but not that much now. Okay. Therefore, if we look at this in conjunction with the fact that the business activities are the same, we are able to identify that if A convert the instrument into shares, plus the fact that they have the same type of businesses, that there will be synergies between these two entities. And due to the fact that there will be synergies, investor A has power over the investee because it will hold voting rights together with substantive potential voting rights that will give the current ability to direct the relevant activities. Therefore, together, not on its own, if we look at the synergies plus the potential, there will be power.